Hi everyone. A portfolio of 100 companies has been mathematically proven to be less risky than owning 5,000. I'm going to show you the university research that proves it and why Wall Street doesn't want you to know this. What I'm about to reveal contradicts everything the financial industry teaches about diversification. Here's the uncomfortable truth. After you own approximately 20 to 30 stocks, additional diversification provides almost zero risk reduction. Research from multiple universities confirms this. Studies show that a portfolio of 30 stocks eliminates roughly 95% of unsystematic risk. Adding more, whether you go to 100, 500, or 5,000, barely moves the needle. But here's where it gets interesting. What if those 100 holdings aren't random? What if every single one is pre-screened for financial strength? That changes everything. Approach 1. Blind diversification. Buy everything. Own thousands of names. Hope winners outweigh losers. Sounds safe, except you're mathematically guaranteed to own every failing business, every over-leveraged firm, every dividend cutter in the market. Take a broad index. You own tech giants at 40 times the earnings next to retailers losing money, firms drowning in debt alongside fortress balance sheets. No screening, no requirements, just market cap weighing. Approach number 2, concentrated quality screening. Start with around 100 holdings, but these aren't random. Every single position must meet strict criteria. 10 consecutive years of dividend increases, strong cash flow relative to debt, positive return on equity, sustainable payout ratios. Immediately, 90% of public firms are disqualified. You're left with survivors, businesses that have proven they can generate consistent profits for a full decade. This is diversification with standards versus diversification theater. Harry Markowitz's work on modern portfolio theory showed that combining assets with imperfect correlated returns reduces risk. But Mayer Statman's research found you only need 30 to 40 stocks to capture most benefits. Burton Malkiel's analysis in A Random Walk Down Wall Street showed that 32 randomly selected stocks capture 95% of available diversification benefits. Going from 32 to 500, almost no additional risk reduction. Studies tracking wealth dispersion found that doubling holdings from 10 to 20 stocks cuts uncertainty by over 25%. Going from 10 to 50 cuts it by over 50%. Beyond 50, the benefits become trivial. Now layer in quality screening. When researchers examine portfolios requiring fundamental strength, cash flow, profitability, dividend sustainability, those portfolios experience lower maximum drawdowns despite holding fewer names. Why? You eliminated firms most likely to cause permanent losses before they entered your portfolio. Real-world application of SCHD. This isn't a theory. SCHD, the Schwab U.S. Dividend Equity ETF, holds approximately 100 firms that passed rigorous screens. The criteria are strict. 10 consecutive years of dividend increases, cash flow to debt ratios exceeding industry medians, return on equity demonstrating profitability, dividend yields that aren't unsustainably high. The index reconstitutes annually and rebalances quarterly. The numbers. 10-year annualized return, 11.5%. Expense ratio, 0.06%. Current yield, 3.8%. Total assets, over $71 billion. Compare that to a total market fund with thousands of holdings where the weakest names stay until they fail. SCHD has experienced smaller maximum drawdowns than broader indices in multiple periods despite holding one-fifth the number of names. How? Quality screening created defensive buffers that numerical diversification alone couldn't achieve. During corrections, firms with fortress balance sheets and sustainable dividends fall less than speculative businesses with no cash flow. By requiring all holdings to meet strict criteria, you build downside protection at the selection level. This is why concentrated quality beats blind diversification. If this is making sense, hit that like button and drop a comment with 100 companies. Can you name all 500 plus firms in a broad index? Can you explain what half of them do? Probably not. But around 100 holdings with clear criteria, you understand what you own. These are businesses generating cash, paying increasing dividends, maintaining conservative balance sheets. When markets crash, and they will, you're far more likely to stay invested when you understand you own financially sound enterprises versus a black box of thousands of unknown names. Behavioral finance research confirms this. Investors who understand their holdings are dramatically less likely to panic sell at bottoms. This persistence during volatility compounds into massive outperformance over decades. Here's what makes financial advisors furious. A simple ETF holding around 100 firms with a 0.06% expense ratio has outperformed 70% of actively managed funds charging 1% or more over the past decade. They can't justify their fees when the math proves concentration beats their diversification theater. Asset managers want you believing more is always better because it justifies higher costs. We manage sophisticated portfolios of thousands of holdings across dozens of sectors. But research shows actively managed funds holding hundreds of positions underperform concentrated funds holding 20 to 40 positions. Why? Fund managers dilute their best ideas with mediocre holdings to appear diversified. Meanwhile, a rules-based fund holding around 100 names that meet clear criteria has outperformed the majority of actively managed competitors. The strategy is transparent. Own firms with 100 years of dividend increases, strong cash flow, and proven profitability. Rebalance quarterly, repeat forever. No stock picking, no market timing, just systematic quality screening with mathematical diversification. Allocate the majority of your equity exposure to quality screened holdings. This could be SCHD or any fund using fundamental criteria to limit holdings to approximately 100 firms. You're getting diversification beyond the 20 to 30 stock threshold research recommends, but you're not owning thousands of names where the bottom 20% are likely in distress. Keep additional allocations for complementary strategies, broader value exposure, targeted growth, or international holdings. But your foundation stays consistent. Around 100 financially strong businesses with proven track records. No guessing which stock to buy. No stress about diversification. The mathematics and quality screening work together, creating both risk reduction and upside participation. When the fund rebalances quarterly, it automatically trims winners that have grown beyond optimal weights and adds to positions that have fallen but still meet criteria. You're systematically buying low and selling high without the emotional burden of manual decisions. Research shows this mechanical rebalancing adds approximately 1% to 2% annually, compounded over 30 years at just an additional 1.5% annually. A $100,000 investment becomes $432,000 versus $156,000. That's an extra $276,000 from rebalancing discipline alone. All because you own a manageable number of quality screened holdings instead of thousands of random names you can't track. The concentration paradox is real. Fewer holdings with higher quality beats more holdings with no screening. Mathematics proves 20 to 30 stocks eliminate most diversifiable risk. Going beyond this provides minimal benefit unless you add quality filters. Around 100 firms requiring 10 years of dividend sustainability, strong cash generation, and consistent profitability give you mathematical diversification, plus downside protection from quality selection. This beats owning thousands of names where 20% might be in financial distress. It's simpler, it's more understandable, and the numbers prove it works. Drop a comment with concentration wins if you've been overcomplicating diversification. Subscribe because I break down the mathematics institutions don't want you to understand. Your choice determines your outcome. Subscribe for portfolio construction strategies that actually work. Like this if you're rebuilding your structure with this framework. This content is for educational purposes only, not financial advice. All investing carries risk. Past performance doesn't guarantee future results. Do your own due diligence and consult a qualified financial advisor before making investment decisions. This is InvestED. Welcome to portfolio construction that survives market chaos. Smash that like button, share with someone who needs this, and subscribe for real market insights. Here's to protecting your wealth and investing smart. Profitable investing.